Hello, welcome. This is Jay, smarthelping.com here, and we're going to go over the travel agency financial model template this morning. Um, so I've zeroed out all the assumptions, and we're going to fill them out manually so you can see how it works. I'll go through each tab. Remember, you can get the template in the link in the description box below. So let's get started here. So financial modeling, we want to try to figure out what's the startup cost, what's the burn, how much equity are we going to need to keep the cash above zero over time, and how can we adjust for all these different assumptions in directly related to how a travel agency operates. So we're going to go Travel Co. LLC. Launch year, let's call it 2024. We'll run it for up to 5 years, so December 2029. We're going to include the exit value and trailing 12 months revenue multiple. We're going to call it 3x. Not going to get into debt funding yet or taxes. Go to revenue streams. So here, I've made up to 12 segments to forecast. So you can figure out, you know, how many bookings are you going to do for business travel, leisure, adventure, luxury, international, etc. You could pick the start month you're going to turn those channels on, whatever they may be. I'm just going to do the first one here, business travel. You can do a starting bookings per month amount. Let's say you do 100 a month. And then let's say I've got a little calculator here to show you what the monthly compounded growth is to get a certain annual target. So let's say you wanted to grow at 10% per year. That would be this amount compounded per month. So if we think we're going to grow 10% per year, I did make the template go out for 6 years, so if you have a partial first year, you can still have 5 full years of operations after that. Gives you a little bit more flexibility. Um, and yeah, that's why it's actually going to December 2029. My bad, not 5 years. It's potentially 6 full years of forecasting you can do here. Okay, so we've got our bookings growth. You can see over here, I just did a helper calc to show you how many bookings you're doing per year based on this growth rate and the starting amount. And then we want to know, well, as a travel agency website like Expedia or something, they book and then they get paid a commission by the hotels and all the different vendors and everything that they're connected to. So what we want to say is, well, what's the average booking value here? So let's say business travel, let's say it's $1,200. So every time someone books, average they're paying $1,200. And then what we want to know is what's the average commission that we make as the booking agency or travel agency on this 1,200. So let's say it's industry average between like 10 and 20%. Let's just say we make 15%. So that means every time there's a booking event, we make 15% of that. And you can fill it out for all the different segments. Um, Next up, I added logic for boutique services because there's a bunch of different ways you can make revenue um, with this type of setup. So boutique tours is more, let's say we start this in May 2024, we start with 5 a month and we grow in this around 10% per year as well. Now what this does is you're charging a upfront fee, let's say $3,000. Actually, these be, well, okay, let's just say 3,000. And then what you're saying is, what are all your costs related to this? Because you're going to collect this from the client and then pay all the expenses, and you just make the difference, essentially a markup, which is the difference between what you're charging the customer and all your different expenses. So here we say what maybe on average for each of these types of boutique bookings, you've got to have 2 professional agents on staff or helping them, or however, how much you're paying them per booking. Let's just say $500. No, let's say $250. So that's $500 per booking because there's 2 of them. Other booking expenses, that you got to pay. Now this would be similar. This here would be similar to what this cost is here, or what this revenue line item is, the booking amount. Because normally in this top style revenue, you're making a commission on the booking amount. In this style, you are charging a fixed amount, and then which is just going to be an upcharge from their booking cost here. So let's say their booking cost is $1,200, and then maybe you have some other expenses, and we could see down here if it makes sense. Yes, okay, we're making a gross profit per boutique booking of $1,250. And there's also ad revenue. So like a site like Expedia is going to make some money on ads. You can say your starting monthly traffic, your growth in traffic, maybe 1% growth per month, average impressions per user per month, maybe it's 10, and then your average amount earned per 1,000 impressions, maybe 450. So there's a potential to make ad revenue. Cancellation rate, let's just put 1%. Okay, so now we've got a revenue, expenses, maybe we got to have some fixed expenses here starting in January. This is a monthly amount, and then you could put, if it's a salary item here, mark a 1, so that's a salary item. I just have a bunch of executives going up top here. Now, my numbers are arbitrary. You'll fill out your own numbers here. So these are all 1. Then maybe you've got like office rent. That would not be a salary item. And then you've also got R&D, you've got sales and marketing, maybe marketing spend. Maybe you have a marketing director. Marketing spend here. You're doing Expedia's doing billions of dollars a year in ad spend, but let's just say to start out maybe 20,000 a month and going up from there, maybe like doubling it each year. That's going to be a big line item cost for any travel agency, especially the online space. It's super saturated. What else? Okay, cost of revenue. So we've got, if your customers are paying credit card fees, maybe 30% of them, actually, with this is going to be a lot. Maybe 90. If it's online, it's going to be most. And there could be ACH. All right, let's just say 90%, and then the credit card fees around 2.9. We also have other cost of goods sold. So if it's a website, you're definitely going to be paying hosting and server costs. Let's start at maybe 2,000 a month and move up from there. Maybe double it as well. Now this, you'll have to do your own research and figure out, what's your traffic look like based on this web traffic here. And you can see on the monthly detail your actual traffic per month. What's that look like? And then make sure you know how much you're going to spend to pay for servers and things like that to support that amount of traffic over time. Now this is a big one, customer service reps. So here we want to scale the customer service reps based on how many bookings are happening per month. So this is saying how many customer service reps you need per X monthly bookings. So if we were to put 0.001 here, that means that one rep can handle 1,000 bookings per month. Like you need the amount of volume or support issues raised by 1,000 bookings would be able to be handled by one rep. And you could adjust these ratios however you want. And then their salaries, 3,500, and so that's going to be a scaling item. You can see on the monthly detail, customer service reps, we're putting that in the cost of goods sold, and that will scale up with the booking counts over time, based on how many there are. Now, in this case, we're only doing 176 bookings a month, so it's not a huge expense. This is saying we only need not even one. Let's say we only a customer service rep can handle 10 a month. Now you can see this is going to scale up quite a bit faster here. Oh yeah, now it's that's probably too much. Maybe 100. One rep could handle 100 bookings per month. That seems more reasonable for this situation. What else do we got here? Payroll tax and benefits, just put 35%. That'll apply to any item marked as a 1 here, and the fixed costs. Okay, so we got that. Startup costs, probably a web design is going to be a big, huge one, especially if you got to develop it. Let's put 100,000. App design could also be, maybe 25,000. We'll put a reserve here. Okay, startup cost, debt schedule. We're not getting into the debt yet. CapEx. So for online travel agency, CapEx isn't going to be a big item, but you can enter whatever you think you're going to have to buy that's depreciable here and label it as the item. You can put the cost. Let's say you're going to buy $25,000 worth of depreciable things for the business with a useful life of, let's say, 7 years. And you're doing that in January. So that's going to populate depreciation expense as well as affect the cash flow in the month of the expenditure. Now, the first row I always leave for a building. So if you're going to buy a building, fine. You can put the cost basis here, useful life, the month of purchase, and value at sale. Now, any debt related to getting this, covering these expenses that you don't want to have to pay out equity for, because right now our case is saying we need $7 million in equity. And that's probably because we're not even profitable. I'll have to check the assumptions. But let's see here. Yes, our EBITDA is negative. Let's adjust some of these assumptions. Let's say maybe we start with 500 bookings a month. Increase our volume. See if that's enough to cover the overhead. Okay, nope, not enough. Still at a loss. Sales and marketing spend's huge. So this revenue does not support those expenses. You're doing 10,000 bookings a year at the end. Let's ramp this up a little bit more. I'll go 1,000 starting, and then maybe growing a little bit faster. Okay, that's profitable. Good. And then, so in this case, we need $225,000 to get started, which is just saying, our initial costs, we have some CapEx, we have these startup costs, and then we're actually running profitable after that. So it's just the net of these costs that we need. So let's say we want to take out some debt. Go 50,000 here. Now don't worry about these div errors. I haven't finished filling out everything yet. So if I fill that out, you can see on the monthly detail, we now have debt proceeds coming in of 50. That's going to offset this total cash requirement. We go to the cap table. You see the 175 is our minimum cash required. Let's say, I leave this as overflow. Leave this as like 20%. And then any founder investments, maybe 25,000. And then they're going to have the other 80% of the profits. And that zeroes out. And you can also see the IRR per investment item here based on the distributions to each and the contributions. Now, if you had other money you're going to raise, let's say you're going to raise another 50,000 here for 5, and you got to reduce this down to 15. You can do that. And however many raises you have and whoever's you're getting money from, you can put that in there. It should never go above the minimum equity required. What startup cost, debt schedule. Okay, So on this, we didn't put the terms in, but let's just say 20-year, 4.5, let's say 6%, 12 payments a year. Terminal value, we're just gonna, this is just for tax purposes on the exit, if you're gonna apply anything to the book value of the depreciable assets or not. I just keep this at 100%. We'll also put in some taxes here, income tax, say 25. So we got a little bit of taxes coming out. What else? So that's, I think those are all the assumptions you fill out. Then we've got financial statement. So income statement, we can see our bookings from retail commissions, or our commissions from retail bookings, the special bookings, top line revenue, advertising revenue, and then refunds, cancellations, then gross revenue. Then you've got cost of goods sold. So here's our direct cost for the special bookings. So that is, the booking cost. This is the upcharge. Essentially from this is how much revenue we're taking on those, and then our special booking direct costs are here. So it's not, we're making a little bit of margin on that. About $12.50 per. What else do we have here? Other cost of goods sold, credit card fees, and then customer service reps. Gross profit after all those variable or cost of goods sold. Then you've got your other operating expenses here. Then we've got EBITDA, earnings before interest, tax, depreciation, amortization. Your interest, your depreciation expense, and then taxable income, taxes, and net income. No, on the exit, if you do include it, the taxes do populate there. We're trying to figure out what the total net cash flow is from the perspective of the equity investors and as the project and the project as a whole. Income statement annual, same deal, but on an annual basis. All these things, these all automatically update as the assumptions change. Balance sheet, our cash position, which we solve for 0. Well, in this case, we have it. Let's do a little bit of burn. So let's say maybe we start off, lower this a little bit. Actually, let's just say this starts in March. So we have a little bit of burn in January, Feb. There we go. So you can see this is always going to default to 0, or it won't go below 0 based on how the model solves for the minimum equity required. So balance sheet, cash, non-current assets, accumulated depreciation, total assets, total liabilities, owner's equity, and we make sure this always balances out. All the logic is working in that case. Now you don't have to include an exit. You can hit no here, and that's fine. And you can also run it for, you don't have to run it for a full term, 6 years. You can run it, let's say, to the end of 2028. In that case, we go back here. Now you can see the end month is 60 months instead of 72, and there's no exit value happening here. You see the executive summary. You just want to make sure these are always 0, or else you've done something illogical, or you've broken a formula or something. But this checks all your financial statements and cash balances and make sure everything zeroes out. Let's put this back to yes. Run this out for the full term. All right, so cash flow statements next. You've got your cash flow from operating activities, investing activities, and financing activities. Total cash, change in cash, which is going to be how you solve your cash balance on the balance sheet based on all these different things. Cash flow annual, same deal. Distribution tab, this is your discounted cash flow analysis for the project up top. So these are the total cash flows of the project in and out. And then for the investors and owners, or inside and outside investors, you could say, their IRR and initial investments and returns based on the cap table assumptions. This row here, cash flow, if you total the whole thing, will always equal the final cash balance of the monthly detail position here, as well as the annual detail cash position here. So $11,975,000. That's what this should always add up to. And it will. Executive summary. This is kind of a high level look at all the line items. So you can see revenues, cost of goods sold, cost of revenue, gross profit, fixed expenses, EBITDA, debt service coverage, average EBITDA per booking, and then other tax or cash flow items like taxes, CapEx, and then final cash flow here, as well as some return metrics. Visualizations, you can see annual revenue, annual gross profit, annual EBITDA, cumulative cash flow, annual expense summary, average value per booking, average commission per booking, count of annual bookings, retail by travel segment. So here we just did one. Annual value of bookings. So this is what you're making the commissions on. Annual revenue by type. And then annual commissions by travel segment. And then annual revenue by type, special bookings. So this is everything you need to see about the business at a high level, and this all auto adjusts. Now, monthly detail, we kind of been back and forth here. This is a really important tab. This is where you're going to see the detail of how many bookings you're doing by segment, what are the value of those bookings, how much commissions are you earning. This is your top line revenue. Then we got the same deal, but for special bookings, those booking revenue fees, advertising revenues, total revenue, and then we have all our cost of revenues here. So you've got special bookings, the fees paid to professional agents, other booking expenses, second other booking expenses. These are not other, this is just the booking expense. This is other booking expenses. Credit card fees. Oh, lost myself. Where am I? Other costs of goods sold, customer support, gross profit, and then all your fixed costs, EBITDA, debt service, and then final cash flow, and then key metrics down here. So everything, all the assumptions are driving into the monthly detail. You've got your annual details, just summarizing the monthly detail. You've got payroll taxes. This is how we're figuring out if there are payroll taxes for the different fixed cost items. And then that is everything. So if we go back here, we got a nice case. You can fill this out with your own data. Remember, don't worry about what I'm entering in these things. You're going to research all this stuff and put in what data makes sense for your situation and your plan and strategy. Like I said, you can get the template at the bottom, description link below. Also, I will list this on smarthelping.com in the general industries tab. It'll be under the services tab or services section. It's also included in the all the license to all the industry specific models as well. And I will put it under recreational activities, industry financial models. Cause kind of fits that a bit, I think. So we'll put it in this section as well. Well, no, I think I want to keep these more mutually exclusive, so we'll probably just put it in. Well, honestly, it fit in the services bundle. I'll put it in the hospitality bundle and the services industry bundle, but it'll be listed one time here on this page under probably under the services industry. Remember, if you want to buy everything I've ever built, you can go to the Financial Models tab at the top, click Learn More. You can get access to over 150 templates here for $9.99. This is every financial model calculator tool I've built on the site. Alrighty, have a good one. I'll see you on the next one.